Cap rates sound complicated, but I'm going to break them down for you so that even your dog can understand them. But before we get into it, do me a favor, do that YouTube thing, like the video, subscribe to the channel, hit the notification bell, share this with a friend if you have any, so you don't miss the next future real-world investing breakdown. Who am I? If you're new, I'm Bud Evans. I'm a retired Air Force officer, former police officer, former mayor, and an active real estate investor with over 50 doors. I buy, rehab, and manage rentals, and I teach veterans, first responders, and pretty much anybody who really wants to get into the real estate industry and get financial freedom, how to analyze deals with numbers and not emotions. If you are investing in real estate and you do not understand cap rates, you are guessing. And guessing with money, that's not investing. You might as well go to Atlantic City, that's gambling. You've probably seen people buy properties because the rent looked good, the payment felt comfortable, or the agent told them it was a great deal, which, why would you listen to an agent? Then the numbers changed. Expenses went up. Rents flattened out. And suddenly, the deal just didn't make sense anymore. Cap rates exist so that you're grounded in reality. Today, you're going to learn what a cap rate is, why it matters, when it doesn't. You don't need a math degree or an MBA. I'm not going to hit you with any jargon. I want you to cleanly understand exactly what you can use it for. So let me tell you exactly what a cap rate is. Cap rate is short for capitalization rate. And the formula is pretty simple. It's your net operating income divided by your purchase price. That's simple. The part that trips people up is net operating income, or NOI. NOI is the income left over after all of your operating expenses, not your mortgage, not your principal. Operating expenses are what it's going to cost you to run the property. So your income, usually rents, minus things like your property taxes, your insurance, your repairs and maintenance, your vacancy, property management, because remember, we always charge for property management, even if we're self-managing, utilities, if you pay them or when you pay them, landscaping, snow removal, if you pay them or when you pay them, and your HOA, if it applies. What's left is your net operating income. Then you divide your NOI by that purchase price. The result is your cap rate. Cap rate is going to tell you how hard your property works before your debt service. Your debt service is your principal and interest, and that's it. That one idea matters because it separates the property from the loan. Now, here is why cap rates really matter. Cap rates let you compare properties objectively. Different prices, different rent levels, different markets, different property types. Cap rates level the playing field. It really answers one core question. How much income does this property produce relative to its price? A higher cap rate generally means a higher return potential, but it usually is related to a higher risk too. A lower cap rate usually means lower risk, but it also means you're paying more for the property for each dollar of income. Cap rates do not tell you everything, but they tell you something pretty doggone fast. So let's look at an easy example. I'll use one of mine. If a property produces $40,000 a year in NOI and you buy it for $500,000, $40,000 divided by $500,000 is 0.08 or 8%. So that is an 8% cap rate. An 8 cap is what we call it. If another property produces the same $40,000 NOI, but it costs $600,000, your cap rate drops. 40,000 divided by 600,000 is about 667, right? So that's a 6.7 cap, 6.7%. Same income, higher price, lower cap. That's going to tell you immediately which deal is priced more aggressively. It's also going to be a pretty good indicator of where the property may be located. But let's talk about what cap rates are good or bad. This depends on the market itself and the asset. In a high demand market where rents are stable and people are fighting to live there, your cap rate will be lower because investors are going to accept the lower return because they believe the income is safer and the long-term value will be stronger. In rougher markets, hi Trenton, I'm talking to you, Camden, you're going to have more vacancy, more tenant issues, unstable rent growth. Cap rates will tend to be higher. Investors are going to demand a higher return because there's just a lot more risk. There is no universally good cap rate. Anybody who says you have to buy a property at a specific cap rate is really oversimplifying things. What matters most here is this: market stability, your tenant quality, your expense predictability, your property condition, the amount of risk you can tolerate, and your overall business plan. Cap rates are context, not commandments. Now, when do they matter most? Let's talk about that, because cap rates matter most when you're buying an income-producing property where valuation is really driven by income. So multifamily properties, 5 and up, we're talking to you. Commercial properties, mixed-use buildings, stabilized rentals where the main goal here is income. Cap rates matter when you want to evaluate the asset itself, not just the financing. They also matter when you sell. And here is the part that most people do not understand. Value equals NOI divided by your cap rate. If your net operating income goes up, your value goes up. If the market cap rate goes down because the property is seen as a safer value, guess what? The value goes up. And that is how investors force appreciation. You increase NOI by raising rents, lowering expenses, fixing vacancies, improving operations. You can also reduce perceived risk with better tenants, longer leases, and clean financials. We're not talking about the stuff that's written on loose leaf paper here. Now, when do cap rates matter less? Cap rates are less useful for single-family homes in appreciation-driven markets because single-family homes are typically priced off comparable sales, not income. Appraisers are looking at what similar homes are going to sell for, not what they might rent for. You still need cash flow. You still need to underwrite the deal. You still need to be conservative, but cap rate is not the primary valuation tool in that space. And this is why most people get confused. Cap rates are powerful, but only when applied correctly. So let's cover the biggest cap rate mistake that most investors make. They ignore certain expenses, or they let someone else estimate expenses in a way that makes the deal look better. Overstated income creates fake cap rates. If someone shows you a high cap rate deal, your first move is not to get excited. First move is to be skeptical. Are the maintenance numbers real, or did they pretend the roof will last forever? Is vacancy realistic, or did they assume 100% occupancy for the next 5 years? Is management included, or are they assuming that you're going to work for free? Are their taxes current, or are they using last year's bill before a reassessment? Did they ignore utilities, trash, lawn care, snow, or electric in the common areas? One fake expense number makes a fake deal look awesome. Here is a practical way to protect yourself. When you are screening deals quickly, use a conservative expense ratio if you don't have real numbers yet. If it's a small multifamily deal and you have limited data, assume that your operating expenses are going to be somewhere between 35% to 50% of your gross rents, depending on the property and what's actually included. Older buildings and tenant-paid utilities are going to matter here. Then you refine as you get real quotes, real tax bills, and real insurance numbers. The point here is not to be perfect on day one. The point is to avoid lying to yourself. So let's clear up some more confusion. Cap rates and interest rates are not the same thing. Cap rates measure property performance. Interest rates measures the cost of your money. A good property can cash flow poorly with bad financing. A mediocre property may look okay with aggressive leverage. A cap rate is going to tell you, does the property make sense as an asset? Financing tells you, is the deal going to work for you? Don't confuse the two. Now, how do you actually use cap rates as an investor? You're going to use them to help you screen deals faster and to spot pricing problems. So ask these questions. Does the cap rate fall into a reasonable range for this market and asset type? Is the deal priced aggressively compared to other options? What happens to the cap rate after stabilization if you raise rents or you cut expenses? What happens if expenses run higher than you thought they would? Cap rates will help you say no faster. That alone will save you time. Now let me pause here, because if you're a veteran and you're learning how to analyze deals properly instead of relying on your gut feeling or sales pitches, this is exactly the type of thing that we work through inside the War Room with David Perret. It is a veteran-only, real underwriting, real numbers, no hype organization. That's why I've been a member for 6 years. The link is in the description if you'd like to talk about that. And if you want direct help on a specific deal, I also offer one-off coaching. You can find that at budevans.com. Now let's go deeper, because this is where investors either get dangerous or get really sharp. Two advanced realities that you absolutely have to respect. First, cap rates move. A cap rate is not a fixed rule. It is a market pricing signal. If buyers get nervous, cap rates go up. That means that values go down, even if your NOI stays exactly the same. So for example, if your NOI is $50,000 and the market goes from a 6 to an 8 cap, your value drops pretty substantially. At a 6 cap, 50,000 divided by 0.06, which is about $833,000 valuation. But at an 8 cap, the value of 50,000 drops your value to 625,000. Same NOI, big value swing. This is why you do not buy deals that only work when things stay perfect. Second, a cap rate does not equal cash flow. The cap rate ignores the debt on purpose. If you put a huge loan on a property at a high interest rate, the property can have a decent cap rate and still have weak cash flow. So your process should be, step 1, use your cap rate to judge the asset. Step 2, run your financing to judge your cash flow and the amount of risk that you're about to take. Both really matter here, and they answer different questions. So let's bring this home. Cap rates aren't scary. They are not advanced. They are simply this, a tool to slow you down, a tool that helps you compare apples to apples, a tool to keep emotions out of a mathematical decision, a tool to help you spot when someone is selling you a story instead of a deal. Now, as always, let's lock this in with a checklist that you can actually use. 1, calculate your NOI. Honestly, using real expenses or conservative estimates. 2, divide your NOI by the purchase price to get your cap rate. 3, compare your cap rates only against similar properties in the same market. 4, use your cap rate to screen deals quickly and spot aggressive pricing. 5, verify your expense assumptions because fake expenses create fake cap rates. 6, remember, cap rate measures the property, not your loan terms. 7, use cap rate heavily for multifamily and income properties and less for single-family comp-driven markets. 8, stress test the deal for higher expenses, changing market cap rates before you buy. If you understand cap rates, you stop guessing and you start investing with clarity. As always, do me a favor. If this helped you, like the video, subscribe to the channel, and hit that notification bell. Share this with your friends who might benefit. Thanks for watching. I'm Bud Evans. Aim high, execute fast. See you on the next one.